There are moments in the life of a market that resist the comfortable categories of the ordinary. They arrive unannounced, they depart without apology, and they leave behind a residue of confusion that the internet, with its extraordinary talent for converting complexity into noise, proceeds to make considerably worse. Silver produced one of those moments this week. On Tuesday, April 15th, the metal surged more than 5% in a single session, climbing from the mid-70s into territory approaching $80 an ounce. As of this morning, Wednesday, April 16th, silver has crossed $80, trading at approximately $80.33 per troy ounce. And if you have spent any portion of the last 48 hours in the proximity of a financial social media feed, you already know that the commentary has achieved a kind of frenzied magnificence entirely disproportionate to and largely disconnected from what actually transpired. What you are about to hear is something rarer than a price target or a prediction. You are about to hear an honest accounting. Not the excited kind, not the fearful kind, the precise kind. And in a market environment that rewards excitement above almost everything else, precision is a genuinely radical act. Let us begin, as all serious inquiries must, with the facts as they actually occurred, because the sequence of events matters enormously, and most of what you have seen or heard this week has scrambled that sequence beyond recognition. Silver entered Tuesday's session trading in the mid-70s. The metal's ascent was forceful, meaningful, and entirely real. By the close, it had pushed towards $79.30. On Wednesday, it extended those gains, and today it sits just above $80.33, pressing one-month highs with a composure that the most breathless commentators seem not to have noticed. This is constructive price behavior. It is not, however, the vertical melt-up that certain voices have been describing with the vocabulary of prophecy fulfilled. What occurred was a powerful surge followed by consolidation and modest extension. The distinction between those two things, between a surge and a melt-up, is not a technical quibble. It is the entire difference between understanding a market and being swept along by a story someone else invented about it. Now consider the broader canvas upon which this particular brushstroke was applied, because silver has never moved in isolation, and to discuss it as though it does is to describe a painting by examining only 1 square inch of canvas. Gold pushed above $4,800 an ounce this week, a level it had not visited since mid-March, and it holds there this morning with what one might call resolute calm. WTI crude oil, which had spiked above $111 a barrel as recently as early April during the acute phase of the Strait of Hormuz crisis, has since retreated, trading around $91.62 per barrel today. Volatile, uncertain, but no longer in the full panic register it occupied just days ago. The dollar index, that quiet determinant of so much that happens in precious metals, slipped to a 6-week low. Cheaper dollars make silver cheaper for everyone who does not earn in dollars, and the world is full of people who do not earn in dollars. Treasury yields eased, equity futures found their footing. The collective tension that had gripped global markets since the United States initiated its naval blockade on Iranian oil shipments through the Strait of Hormuz, one of the most consequential choke points in the architecture of modern global energy, exhaled, just slightly, in a single Tuesday session. That exhale requires explanation, because it was not accidental and it was not arbitrary. The week had begun under genuine duress. The U.S. military had effectively halted commercial maritime traffic linked to Iran. The weekend peace talks between Washington and Tehran had collapsed. Crude oil, as noted, had been trading above $100 a barrel, at times well above it, and analysts with serious reputations were warning that a sustained closure of the strait could drive prices to levels that would remake the inflation calculus for every central bank in the developed world. Markets, in the vocabulary of behavioral finance, had been pricing the worst-case outcome. And then, with the particular abruptness that only geopolitical developments can manage, something shifted. Reports began circulating that both Washington and Tehran were working toward a second round of negotiations before the expiration of the current 2-week ceasefire window. President Trump stated publicly that Iran had reached out. Iranian President Pezeshkian signaled a willingness to engage. The thread was thin. It was fragile. It was, to use a word that carries the appropriate weight of its uncertainty, unguaranteed. But markets, which had been bracing for the most aggressive imaginable outcome, decided in that single session to stop doing so quite so aggressively. Here is the point at which I must insist on a discipline that the financial commentary ecosystem finds deeply inconvenient, because it interrupts the momentum of a satisfying story. When a market retreats from a worst-case scenario, it does not retreat from the risk. It retreats from the most extreme, near-term pricing of that risk. Crude oil falling from above $100 toward $91 does not mean the Strait of Hormuz is open. It is not open. The blockade remains effectively in place. The U.S. Department of Defense has announced plans to deploy additional troops to the region. Iran has warned of retaliatory measures. Analysts across the energy complex continue to model scenarios in which oil returns above $100 if the second round of talks fails, as the first round did. The risk premium did not disappear. It merely recalibrated to reflect a slightly reduced probability of the most catastrophic near-term outcome. This distinction is not pedantic. For anyone making financial decisions in the current environment, it is the most important thing to understand, and the last thing most commentators will bother to tell you. The second engine propelling silver's Tuesday surge was not a geopolitical development at all. It was a number, a single economic release that arrived in the middle of all this geopolitical drama with the quiet force of a well-placed argument. The March Producer Price Index came in softer than economists had braced for. Headline producer prices rose 0.5% on the month. On an annual basis, producer prices remain up approximately 4%, which in any ordinary historical context represents a troublingly elevated reading. But the expectation going into that release had been for something worse, for evidence that the energy shock from the Hormuz crisis was beginning to bleed into the broader cost structure of the American economy in the aggressive, self-reinforcing way that inflation sometimes does once it escapes its initial sector. The stripped-down core measure also landed more modestly than feared, and a market that had been genuinely bracing for an ugly number heard instead something that was bad but not catastrophic, which in the current psychological environment spent like a small windfall. The Federal Reserve's rate cut probability, as measured by market instruments, nudged up to roughly 30%. Not conviction, not a policy pivot, but the tentative reopening of a door that had seemed firmly closed. Now I want to tell you something about silver that the excitement of a 5% session almost invariably causes people to forget, and forgetting it is one of the more expensive mistakes available to a modern investor. Silver is not gold. It has never been gold. Gold is the instrument of settled conviction, the asset toward which institutional capital, central bank reserve managers, and the accumulated weight of monetary history migrate when the conclusion is already obvious. Gold above $4,800 this morning is not a surprise to anyone who has been watching the structural story of 2025 and 2026 with clear eyes. Central banks adding to reserves at a pace not seen in decades, real interest rates fluctuating in ways that periodically favor non-yielding hard assets, and geopolitical uncertainty layered over a global economy already laboring under debt burdens that would have been considered extraordinary in any previous era. Gold is, to employ a nautical metaphor that I think captures the essential character of the thing, the steady ship. Silver is the speedboat, and the speedboat does not look impressive when the water is calm. But when the water moves in the right direction, even modestly, the speedboat does not merely move, it launches. What the market possessed entering Tuesday's session was a speedboat under extraordinarily high tension. Silver had been coiled, a word that the financial press uses somewhat casually but that carries genuine mechanical precision in this context. High volatility assets in intense positioning environments do not require massive catalysts to produce dramatic price movements. They require triggers, events sufficient to release the energy that has been accumulating quietly through days or weeks of compressed spring. What they received on Tuesday was not one trigger, it was three, arriving with the near-simultaneous quality that markets occasionally produce, and that produces in turn the sessions that people remember. Geopolitical tension eased at the margin. Inflation data came in softer than feared at the margin. The dollar weakened. Each of those developments, arriving alone into a more relaxed market, would have been a footnote. Arriving together into a market wound as tightly as this one, they became a slingshot. And the resulting move attracted exactly the follow-through that technical markets always generate in these circumstances. Momentum traders noticed. Short sellers began covering positions with the particular urgency of people caught on the wrong side of a fast move. Every chart analyst with a functioning screen began watching the same key levels simultaneously. Round number psychology, that thoroughly irrational yet entirely predictable feature of human behavior in market settings, began operating with its full gravitational force. Silver had been trading in the mid-70s heading into this week. When it cleared the $78 and $79 area and began approaching 80, a level that had occupied the conversation of every metals commentator for the better part of several months, something changed. Not in the metal. in the people watching the metal. $80 is not, from any rigorous fundamental standpoint, different from $79.99. A metal trading at one price and a metal trading at a price 1 cent higher are, as a matter of chemistry and physics, identical objects. But they are not psychologically identical. Not to the television producer deciding what story justifies a segment. Not to the retail investor who set a price alert and just watched it trigger. Not to the risk manager whose models are built around round numbers because the people who built those models understood that other people's models are also built around round numbers. $80 changes who is paying attention, and who is paying attention changes how price behaves. This is not mysticism. It is an observation about human psychology in competitive settings that has been confirmed across enough markets, over enough decades, that disputing it has become a form of intellectual vanity. Before we go further, and what comes next is where this analysis gets genuinely uncomfortable, which is precisely why most commentators skip it, I want to speak directly to something. If you have been building a position in silver through the long, unrewarding months of sideways action that preceded this week, through the drawdowns that tested patience, and the extended periods when holding the metal felt like arguing with a wall, you have earned the right to feel something this week. Not euphoria. Euphoria is for people who arrive Tuesday afternoon and have already forgotten that markets move in both directions. But confirmation. Quiet, earned, patient confirmation. The kind that only belongs to people who understood the thesis before the move made it obvious to everyone else. And if that describes you, if you are one of those people, I would genuinely like to know your story. Drop it in the comments. Not the price you paid, the experience. Because what actually draws people toward the discipline that this kind of investing requires is not someone else's exciting chart. It is hearing from other human beings who endured the boring parts, the uncertain parts, the parts where social media was telling them they were wrong, and came through the other side with a position they understood and believed in. That story is worth more than any price target I could give you. But subscribe first, because what I am about to tell you in the section ahead is the part that the silver bulls in your feed are deliberately not telling you, and it may be the most important thing you hear about this metal all week. The difference between the investor who navigates the next several months successfully and the one who doesn't will come down almost entirely to whether they understood what I am going to explain next, before the next headline arrives. Most people will hear it too late. You will not be one of them. The silver market is currently operating inside an unusual structural tension between two stories that do not normally move in the same direction simultaneously, and yet both of them, at this particular moment in history, are pointing toward silver. The first is the fear story. The world has a genuine energy supply shock embedded in its near-term outlook. The Strait of Hormuz, through which a remarkable fraction of global petroleum transits daily, remains under effective blockade. Oil, even in its retreated form at roughly $91 a barrel today, represents a price level that bleeds into transport costs, manufacturing costs, and ultimately consumer prices in ways that monetary policy cannot address because monetary policy cannot open shipping lanes or replace petroleum infrastructure. When investors cannot trust the currency of account to maintain its purchasing power reliably, they reach for things that are not anyone else's liability. Silver is one of those things. The second is the relief story. If the conflict de-escalates, if Washington and Tehran find enough common ground to reopen the strait and allow oil to return to pre-conflict levels, inflation expectations recede, the Federal Reserve gains room to contemplate easing at some future date, real rates soften, and the opportunity cost of holding a non-yielding hard asset diminishes accordingly. A more stable macro backdrop encourages flows into higher volatility assets rather than the defensive postures that acute crisis demands. Notice what just happened. Two completely opposite scenarios, fear escalating and fear receding, both point towards silver. That structural duality is part of why Tuesday's move was so intense. Silver was positioned at the exact intersection of monetary metal and industrial commodity and geopolitical hedge, capable of absorbing flows from both directions simultaneously. The fear buyers were not selling because the crisis had not resolved. The relief buyers were arriving because the worst immediate scenario seemed slightly less probable. Both flows entered the same instrument at the same time. That is not accident. That is structural positioning of a kind that does not happen frequently, and that produces, when the right catalyst arrives, sessions that look inexplicable but are, once you have the full picture, entirely comprehensible. And yet, and here is where intellectual honesty requires that we introduce the element most enthusiastic silver commentary studiously avoids, the story is not without its complications. The industrial demand case for silver, which is genuine, and which involves solar panel manufacturing, advanced electronics, medical technology, and high conductivity applications across a spectrum of modern industries, is not the frictionless upward slope that its most ardent advocates describe. Silver has risen dramatically over the past year, up more than 140% compared to the same period last year, according to current market data. And commodities that rise dramatically over sustained periods have a way of motivating the engineers who work with them to find alternatives. The Silver Institute and Metals Focus have now warned of a sixth consecutive year of structural supply deficit, with 762 million troy ounces drawn from above-ground stocks since 2021. Industrial demand, meanwhile, is projected to decline approximately 3% to 640 million ounces in 2026. This is not a contradiction to the bullish case. It is a complication within it, and a thesis that cannot accommodate complications is not a thesis. It is a wish list that the market will eventually, and with characteristic lack of sentiment, correct. Silver does not need every solar manufacturer to preserve exactly their current silver content forever. It does not need the industrial demand trajectory to be flawless. It needs the structural supply deficit, which has now run for 6 consecutive years, to continue operating faster than substitution and thrifting can offset it. It needs investor demand to remain serious. It needs the monetary and geopolitical uncertainty that makes hard assets relevant to continue doing what it has been doing. All of those conditions are present right now. None of them requires a perfect world to function. A good thesis never does. The Federal Reserve currently holds its policy rate in the 3.5% to 3.75% range and has communicated no urgency to move in either direction. Rate cut probability sits at roughly 30% for some point this year. Not conviction, not a pivot, but the reopening of a door that had been firmly closed. The dollar index sits near 6-week lows. International organizations continue warning that elevated energy costs are dragging on global growth projections. None of that is the perfect setup that the most enthusiastic commentators describe. All of it is the unresolved, uncomfortable, uncertain middle ground where silver has historically done its most interesting work. The question that matters more than whether silver can tag $80, it already has, at $80.33 today, is what silver does when the headlines go quiet. Because headlines create moves, fundamentals sustain them, or expose them as illusions. The period immediately following a dramatic breakout is always the most revealing in any market, because it is precisely when the adrenaline investors who arrived because the chart looked exciting begin to be separated from the conviction investors who arrived because they understood the thesis before the chart moved. I would watch, in the sessions ahead, whether buyers appear on the quiet sessions, the ones with no fresh geopolitical development, no inflation print, no Fed commentary to provide cover. I would watch whether the overnight sessions in London and Asia hold the gains that New York produced or systematically sell them back. I would watch whether gold sustains itself above $4,800, because gold at that level is its own signal about the macro environment independent of any individual data release. I would watch the dollar carefully, because dollar weakness was a meaningful component of Tuesday's move, and dollar strength would be a meaningful headwind. But above all else, above every other variable in this entire complex, I would watch crude oil. WTI at $91.62 a barrel today, down from $111 just 2 weeks ago, represents one macro environment. WTI back above $100 represents a different one. WTI falling toward $80 on genuine peace progress represents yet another. The path of crude oil through the Strait of Hormuz situation is arguably the single most consequential variable for everything that happens in the precious metals complex over the weeks ahead, and anyone who tells you otherwise is either not paying attention or is selling you something. Now, I want to speak carefully to the question that I know is forming in the minds of many people watching this move unfold in real time: whether to participate. And I want to give you the honest answer rather than the satisfying one, because the satisfying answer would be easy to construct and would not serve you well. If what you mean by participation is buying out of the emotional urgency that a 5% single-day move generates, if you are considering committing capital because you are afraid of being left behind, because the screenshots are everywhere and the excitement is loud, I would encourage you to sit with that feeling for a moment before acting on it. Silver can humble investors with extraordinary speed. It can make a breakout look effortless and inevitable and then spend weeks, sometimes months, extracting payment from everyone who arrived late and without a plan. The history of this metal is full of those episodes, and the current environment, with genuine unresolved conflict, an uncertain policy trajectory, and crude oil that has not decided where it is going, is precisely the kind of environment where that reversal can happen quickly and without warning. Position sizing without a framework is not investing. It is gambling wearing the vocabulary of investing, and the market is very good at collecting the proceeds from that particular confusion. If, on the other hand, what you mean is whether this week strengthens the broader case for silver as part of a long-term hard asset allocation, the answer is different and more favorable. It does. Not because a single session proves a thesis, no single session proves anything lasting, but because Tuesday demonstrated something that a somewhat complacent market had needed to see demonstrated. Silver responds. When the macro conditions align in its favor, even partially, even ambiguously, even incompletely, it responds with a force that commands attention. That is useful evidence for the patient investor who has been building carefully through the long sideways periods, through the testing drawdowns, through the social media cycles declaring the trade finished and the believers foolish. Those investors are not at risk of being humbled by this move. They have earned the right to feel something more valuable than excitement. They have earned the right to feel confirmed. What Tuesday and Wednesday of this week did not do is resolve the questions that silver's performance ultimately depends upon. They did not reopen the Strait of Hormuz. They did not produce a peace agreement between Washington and Tehran. They did not give the Federal Reserve the data it needs to pivot with confidence. They did not guarantee that the sixth consecutive year of structural supply deficit will not be partially offset by substitution in industrial applications. What they did was remind a market that had grown accustomed to silver drifting sideways that this is an asset capable of violent repricing when multiple catalysts arrive simultaneously into a positioning environment that has been wound tight for weeks. That reminder has value. It is evidence of the metal's continued relevance in a macro environment that has given it every reason to remain relevant. But relevance is not inevitability, and any commentator who tells you this week's move has resolved the uncertainties rather than simply navigated them temporarily is telling you what you want to hear rather than what you need to know. Silver exists and has always existed in the space between questions that refuse to resolve cleanly, between monetary metal and industrial commodity, between crisis hedge and momentum trade, between the fear that something is deeply wrong with the global financial order and the relief that perhaps it is not quite as wrong as yesterday's headlines suggested. That is not a comfortable place to invest. It never has been. But it is an honest one. And in markets capable of extraordinary dishonesty in the short term, honesty is ultimately where the durable edge comes from. Stay grounded. Stay patient. Understand what you own and understand why you own it before the next dramatic session arrives and tempts you toward decisions made in haste and regretted in quiet. Now here is what I want from you, and I mean this sincerely. Drop into the comments and tell me, is this the beginning of a more durable move, or does silver still need one more shakeout before it can run with genuine conviction? I read every comment, I think about every argument, and your perspective from wherever you are watching this sharpens my own thinking in ways that no research report can replicate. This is a conversation, not a lecture, and the best conversations require both sides to show up. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.